Clara Hermit, and this is Breaking the Mould, our regular look at the financial markets with Investment Director Russ Mould. Russ, how are you doing?
Very well, Clara. How are you? Looking
I'm
fresh
fine.
as a daisy, springing and all that?
Yeah, it's definitely working for me.
Good.
Russ, what's the fuss?
Okay, well, there's again a lot of news coming out in the next couple of weeks, but for me, the fuss is all going to be about two things: groceries and glad rags. It's your kind of show, I think. And we've got full year results from supermarket chain Morrisons and the second quarter trading statement from online retailer ASOS on the same day, the 12th.
Okay, so let's kick things off then with the troubled FTSE 100 giant, Morrisons.
Troubled? That could be a euphemism. I think you've been quite kind there, potentially. Bradford's finances had a very tough 12 to 24 months, and again, figures coming up on Thursday the 12th. Now, new boss and former Tesco man David Potts, he only starts work on the 16th, following Dalton Phillips' exit after 5 years at the helm, so we probably won't get too much from the new man, or therefore on anything that he's thinking strategically. However, the figures are still going to be of interest, not least because Morrison shares have actually had a nice rally. Now, they bombed out all the way down to about £1.50 and have since rallied to near enough the £2 mark, as this chart behind us shows.
Okay, so what has caused that rally?
It's a perfectly good question, and it sounds awfully brutal, but I suspect that Mr. Phillips getting the chop has probably had something to do with that. In the end, investors, I think, were becoming increasingly concerned that he wasn't dealing with the company's perceived strategic weaknesses of online and convenience stores, even if he did broker the Ocado deal to try and help the company crack this home shopping weakness. Now, in addition, I think a lot of investors took the view the news could hardly get worse at £1.50, and especially as analysts were falling over themselves to be bearish of the stock. 4 buyers, 5 holders, and 9 sellers. So in that respect, again, sentiment very, very depressed. I think also value hunters may have got looked at the dividend yield. We talked about income a lot. Now, the company increased its interim by 5%. And even if it holds the full year dividend unchanged at 13p, down at £1.50, that was a dividend yield of around 9%, even just short of £2, it's 6 and change. That's a big fat figure.
The dividend is one of the big numbers to watch,
be.
but what are the others with those full year figures coming out?
Yeah, I mean, the consensus figure for income pre-tax for the year is £382 million, but it's going to be a very dirty, messy number, lots of one-off charges, but besides the headline, the market's going to be humming on like-for-like sales, which were down 5.2% in the key Christmas period, so you're really looking for an improvement in the top-line momentum. Progress with a £1 billion self-help cost-cutting programme, whether there's been any further drops in the number of items on promotion to help returns on sales, and finally the balance sheet, net debt was £2.6 billion at the interim stage, but was coming down. Now, the lower debt goes and the better the operating margin, the safer the dividend becomes. And I'm sure but nevertheless, this is an area I think Potts will have to revisit. The chart behind us shows the bars are earnings per share and dividend per share. The line is cover, and dividend cover is down to about 1 times. It should really be 2-ish to be comfortable, so that's a fat divvy, might not be entirely safe.
Okay, that's one retailer in the bag. Should we talk about...
Boom!
I try.
That's all right.
Should we talk about the other one, ASOS?
ASOS, again, it's a company that's had a very, very tough year. Number of profit warnings and operational miscues absolutely hammered the shares. Again, you can see here, £70 all the way down to 18. But again, a nice rally up to 31 as the market's been thinking, okay, is the worst now behind us? So when we've got numbers coming up, again, the same day as Morris on the 12th, there can be a number of things that people will be looking at. The first is the UK business, 15% year-on-year growth in the key Christmas period. Great number, a lot slower than we've been used to from this company, still a good number. International has been a challenge for them. In the 6 weeks up to January the 9th, overseas sales were up just 5%. I think the euro-sterling exchange rate's been a nuisance there, but that wasn't great. And then any comment on margins, since gross returns on sales slipped by 2 percentage points at Christmas, so pricing pressure from other online retailers and probably some high street ones as well, quite frankly. There'll also be hopes for reassurance on the Barnsley warehouse fire, IT investment, because the firm does really need to get back on the earnings growth track to maintain this share price rally and justify a forward valuation of around 70 times earnings. The chart shows that's pre-tax profit. It has hit a bit of a flat spot. There's not been a 6-month job, it's now a couple of years.
Okay, thank you, Russ.
Pleasure.
And thank you to all of you for joining us. We'll see you next time. Goodbye.